Good evening, ladies and gentlemen. Thank you for standing by. This is Tanvi, the moderator for your call today. Welcome to the post-results conference call of AIA Engineering Limited. We have with us today the management team of AIA Engineering Limited. At this moment, all participants are in listen-only mode. Later, we will conduct a question and answer session. At that time, if you have a question, please press star and one. I would now like to turn the conference over to AIA Engineering management team. Please go ahead, sir.
Yeah, thank you so much. Good evening to everyone, and thank you for joining our call. Sanjay and I here, are happy to take this call for the third quarter of this year, for the period ending December 2021. I will just quickly run. We have no major updates for this quarter. All our commentary remains in par with what we've done the previous last two quarters. I think the major highlights remain around headwinds with the supply chain linked interruptions with containerized cargo. I think sea trade continues to be hampered and continuous interruptions in terms of global developments are keeping that trade related pricing afloat and buoyant. It could be a quarter or two more before we may get relief on that account. I think the last lockdown in China on account of COVID has again brought back the situation to where it was. It had started improving, but the lockdowns on many ports has ensured that cargo is still sitting either in ships awaiting clearances or in their ports, and it has led to jams in the second, third order. So shipping continues, sea freight continues to be a headwind, not just from a cost standpoint, but also we had to reorganize our supply chain. Customers want more visibility, more stock on the ground on one side, and on the other side, when we're going in and offering a solution to replace a forged incumbent, that extra cost is becoming a challenge as far as our conversation is concerned. Nevertheless, our work around down process benefits, our development with mill linings, they continue at a great pace, and hopefully as things settle down, we would have good news to share in terms of we are very excited in terms of where the global mining industry is. Metals like copper have a structural tailwind behind them in terms of their end use in lots of applications around electrical vehicles and the distribution around it. And it looks like that new capacity is tough to come by. Our solutions that help miners recover more copper as well as produce and or process more ore through our solutions of mill linings look to be a great fit with that industry situation. But that comes with the caveat around the shipping rates. The other headwind that we had over the last 3 quarters was around the galloping raw material costs. They finally seem to have stabilized, of course, at a very high rate. And again, that's in sync with the global commodity, the way they've moved. So we've been that the whole pass-through process, has been the biggest effort as far as our sales team is concerned, and I'm happy to report that we've been able to pass through sizable amount of these cost increases. Cost increase on account of commodity price increase, also cost increase on account of shipping. Both of those have to come through. This quarter we saw some amount of that come through. We hope this continues in next quarter or two also. From a headline number standpoint, we sold 58,000 tons. It was below our expectation of about 67,000 tons, but we added about 17,000 tons to stock, on account of these longer transit times and the clearances at different ports. So a lot of our cargo is actually sitting as transit inventory, and hopefully some will convert into sales next year. But for 9 months, we are at par with what we did. We'll be doing about 186,000 tons for 9 months, and that 187,000 tons, and that compares with a similar amount we've done in 9 months last year. This is after losing 23,000 tons of volume that we'd done last 9 months to our customers in South Africa and Canada. So unfortunate that that event happened, but in real time we would have been otherwise happy to have reported at least a 25,000 ton growth in 9 months compared to the previous months. You all must have had a chance to look at the numbers, but I'll still run through a quick snapshot. Our pass-throughs, every quarter are reflected in our realization per kilo. If you will, what was 105 rupees, for the full fiscal year 21 was 121 for the first quarter. That went up to 126 in the second quarter, and that's 143 rupees a kilo in the third quarter. So that reflects the increase in the pass-throughs. From 105 to 143, there's almost a 40-45% pass-through in absolute terms. But when our cost raw materials was 45 to sales, so almost 100% pass-through in raw material has come through in last 2-3 quarters. Ferrochrome, continues to be high. That's at about 115 to 120 rupee price range versus about 60-70 rupees, for the full year 21, 70-75 rupees. And likewise, scrap, is again at an all-time high, around 40 rupees a kilo, up from 25-30 rupees in the previous fiscal year. So we're happy that our teams have come through, and the whole proposition of pass-through has not been a difficult conversation. So our top line, so we produced 75,700 tons, and we sold 58,000 tons. Our top line, our revenue figure is at 833 crores, and that's also reflecting the increased realization. Our other operating income, which is drawback, is at 15 crores. We've lost about equivalent amount on MEIS. We would have earned approximately 15-17 crores on MEIS, which is not there in our income, at this time. The non-operating income includes forex gain of about 13 crores and our treasury income, the balance of about 28 crores of treasury income. The rest of the numbers, I think, are in line. Our sequential, if you compare to second quarter, our raw material after adjusting for inventory to sales has gone down from 45 to 38%, and that's reflecting the pass-throughs that have come in. I think in the other expense, we've got about 15-20 crores of additional freight that we've incurred compared to the sequential second quarter. I think that's what took away additional 2-3% that could have accrued to us this quarter. Hopefully those pass-throughs will come through in next few quarters. So our EBITDA is at 23.99, about 1.5% more than the previous quarter, and profit after tax is at 138 crores, at similar to what we did in the second quarter, and 425 crores for the full year. Some more 9 months, sorry, 425 crores for 9 months profit after tax. From a capex standpoint, we'll continue to do about 200 crores is what we have budgeted for this year. The actual amount may be a little lower than that, but that can spill over. Broadly, the capex for next year, we're estimating at about 200 crores, 50 crores for the mill liner project. Money that has to be put into capitalization. And the plants expected to come on board, which was March, has moved to April. So we expect to commission or start the trials for the plant in April 2022 this year. We plan to add hybrid wind solar power plant, captive power plant over 5.4 megawatts. That should be about 40 crores of investment. And we're budgeting about 100 crores for land and other general capex. So broadly about 200 crores of capex, for next year. Our net cash, our total cash is about 1988 crores, 1988 crores. We've got borrowing of 125 crores with a net cash figure of 1862 crores. That's down from 2019 crores end of March. A large part of that, besides dividend and fixed asset investment, there's an addition of about 375 crores of working capital. A material part of that coming in terms of transit stock that I talked about earlier. So and the customers' need for more stock on ground. I think the current working capital reflects that situation. It may not go up materially from here, but we've used 375 crores in working capital in this 9 months, and to that extent, our net cash balance remains at 1862 crores. I think that brings me from a number standpoint. I think those are the material figures. From a business standpoint, I think besides the ocean freight situation, we are much more comfortable with the raw material cost increase and the pass-throughs that have come through. We are building our organization in terms of the developing the markets that we are strongly looking at, which is the Americas and Africa and Australia. We continue to make investments in resources and leaders to make sure that we can cater to this growth that we are anticipating once the ocean freight situation normalizes. Like I was explaining before, we continue to remain excited about our capabilities for down process benefits as far as chrome is concerned, chrome grinding media is concerned, and mill lining solution whereby we can improve throughput and power consumption. And that's the same commentary that we had made the previous quarter. We'll be happy to take questions from here on. Yeah.
Thank you.
Hang on, Sanjay bhai, I just have Sanjay bhai share.
Very quickly add a couple of points which are of very relevance according to the internal strategies with which the company is working. So first, as Kunal explained, the redeeming feature is that a significant amount of pass-through is happening, both for the raw material as well as for the freight costs. So the pure operating EBITDA, if all of you guys, if you exclude other income, is slightly better in Q3 at around 19% plus as compared to a little lower figure in the previous quarter. Second important feature, while as we speak, last month, that is December, was looking a little grim globally because of the Omicron effect. But as we speak, as on today, things look to be much more relaxed. Even worldwide, while initial knee-jerk was that some of the travel restrictions or some of the countries reacted negatively, but I think most of the countries have now understood that the effect of Omicron is more temporary or not really serious, and therefore things should not be shut down. So hopefully, even in India, we see the reported number of cases going down dramatically in the key metros. So hopefully this should pass much more quickly than what was initially looking to be a threat, and that's a very great relief. Directionally, we are bang on in terms of all the developmental efforts, and the fact that notwithstanding losing about 23,000 tons between Canada and South Africa, we're still more or less at par, shows that there are gains in all critical important countries which are under focus, and therefore directionally our medium to long term goals, focus, opportunity profile, everything remains the same. So I think it's just a matter of maybe a few more months and we should be on a much more firmer wicket in terms of how quickly we can start converting the customers so as to give a consistent, significant volume growth year over year. I think with this, moderator, you can open the house for Q&A.
Sure, sir. Thank you. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your touchtone telephone and await your turn to ask a question when guided by the facilitator. If your question has been answered before your turn and you wish to withdraw yourself, you may do so by pressing the star and 2 key. You are requested to use handsets while asking a question. First question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, good afternoon, Kunal sir and Sanjay sir. My first question is with respect to the volume. So 9 months volumes have kind of been flattish for this first 9 months compared to last year. You had talked about some amount of developmental efforts that we are taking across the globe. So if you can give some more clarity on kind of are they coming out of new mines that are getting opened, new customers getting added, or there is a possibility of existing customers giving higher volumes, and what kind of volumes we can expect over in the next fiscal year, or probably over a 2 to 3 year basis? It will be really great, sir.
So, Ravi, next fiscal year is difficult to give a guidance on, simply because it may take, at least 2 quarters for the freights to normalize, right? And there is nothing that we can do about it. But, so let's talk about fiscal 24 onwards. I think adding 35,000 tons a year should be possible. All our efforts are geared towards that. So, and that's a combination of everything. And we've discussed this enough, how it takes time. It's not right for us to say these 4 mines will give us so much, because so we're doing much more, hoping that at least 35,000 tons of customers convert.
And just to add what Kunal says, even we are not saying next is not going to happen. What we are saying is that we'll be able to give you a little better predictability.
No, despite the worst 9 months, Ravi, we've grown 23,000 tons, over 187,000 tons of volume, right? We lost that market for reasons outside our control.
Got it.
Which is South Africa and Canada, right?
Next year can happen.
The question is, next year we are very focused on growth in fiscal 23. To give a guidance is a tough one. I mean, we are not able to go out wholeheartedly simply because we know there's, headwinds in terms of lower hanging fruit, types of tonnage also may take a little longer to convert given the cost difference right now with the sea freight.
Got it. And that 23,000 odd tons, is it like a temporary loss, or it can come back?
23,000 tons is Canada and South Africa with the duties that came in.
Yeah, correct. So basically, I mean, is it going to be a kind of a medium-term lost opportunity? Can it come back, say, 2-3 years from now?
There's a lot of variables at play over there. I mean, both markets also have a sea freight issue today. So, we will address those as things as the sea freight situation improves.
Got it, sir. Got it. And in terms of margins, so basically, I mean, at one end, input costs have gone up. We are trying to pass on to customers, and ocean freights have also gone up. So our margins are more in the range of 18 to 19%. Can it climb back to, say, more than 20% in the next 2 years? So basically, or is it likely to remain in the range 18% range?
So Ravi, there's enough history for you to model this, but we will continue with our parroted response of 20-22% is a comfort margin, and we hope to be there. It's difficult to say that when we are in this cycle of a lag pass-through cycle, right? So it's happened in the past. We would hope it will happen going forward as well.
Got it, sir. Thanks a lot, sir.
Thank you, Ravi.
Thank you. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi, Kunal and Sanjay. So firstly, on this margin part, I think this quarter, I think we should not look at the percentage margin, because if we're seeing almost like 40% realization growth, we cannot look at percentage margin. So if you look at probably, if at 105 rupees we're making 25% margin, we're making 25,000 rupees per ton. Now let's say even 18%, 19% margin, we're making almost like 27,000 tons. So I'm really surprised this margin performance in this quarter if you look at EBITDA per ton basis. So my question is that, is there any element of basically pass-through of previous quarter as well in this quarter, or this is just normalized pricing for the quarter?
No, there is a pass-through from the previous quarter. No, the price variation formula works pegged to, with a leg.
No. So my question is that, is there any pass-through which was retrospective basis also effective there, like say for the previous quarter we got?
No. You're saying any credits we accrued?
Yeah.
No. This is current period, current pricing.
Okay, so if the full pass-through has not happened, and also in this quarter volume was lower because of this whole, you said that stocking has happened. So when the volumes improve and the pass-through happens further, there is a possibility of margin improving further from here. Is that correct assessment?
We'll see exactly the pass-through cycle is in the process. We'll see over next 2 quarters, but that's directionally that's where it's headed.
So there are multiple customers where different price points, different formulas for pricing and passing through. So it's not.
Yeah, and also different components. The freight pass-through, the increase in freight for this quarter was not something that was budgeted, right? So exactly. So it's not just raw material, it's the other.
So simple.
Power costs have gone up. Other costs have also gone up. So it's not just a one-to-one commodity price increase. The other costs that are also required to be passed through. So that's the effort, to try and pass through as much as we can.
No, but I am saying that despite all that non-pass through, still the profitability in per ton, which is very high compared to what we have done historically. So I'm really surprised with that. It's a very good number in my view. Secondly, in terms of volumes that we have garnered in this year, 23,000 is lost from Canada and South Africa. Which minerals are contributing to this growth this year? Which are the critical?
One more clarification regarding your margin. You see, we have always maintained that it's also a function of the product mix in a given particular quarter. So between the castings and grinding media, if the product mix is more tilted towards bigger castings, then the profitability or per ton could become higher arithmetically. You will not read everything based on just one quarter. That I am very clear. Otherwise, But you are right. See, there are two things. One is the capability that both in grinding media as well as in castings, whether we have been able to pass through all the costs more. In most of the cases, therefore, the answer is yes. This particular quarter, again, castings versus grinding media, there was a little more tilting in favor of castings. So, but next quarter, again, there could be a little more tilting in favor of grinding media. So maybe an annual kind of or a 9 months kind of a averaging would give you a little better idea. That's all I wanted to add.
No, got it. That's okay. I think, even if full pass-through has not happened. So, but on that context, we saw actually fall in the cement and utility volumes versus last year. There's a bigger fall than what we saw in mining. So over there, is it because of freight element, the stock which is stuck at port, or what are the reasons? Like we saw.
No, it is stuck. It's awaiting boats. It is on the ship, but it's transshipped and it's taking longer. Or the customers looking for more stock on the ground. It's a combination of all of that.
Okay. And say my second question was that on this volume side, this year what we added, any color you can provide which minerals we have added more in this year, like that 20,000 extra?
So we added gold, copper and iron, all three.
Okay, and gold. And on this copper front, and you also mentioned about I think a new strategy or focus for America market. So can you throw some more color on what is happening in say a country like Chile, how we are faring basically, or what we will do differently to increase share over there?
I think we don't want to speak too much publicly about our strategy there. I think it's for us to actually go out and work on some of that. It's a little also premature because shipping rates are against us for those markets today, right? So allow us some time to talk about it while we firm up and convert some customers in those regions.
Okay. And lastly, on the liner side, the plant will come up by March, April. So we should see the maximum impact from there only in FY24.
Sorry, your voice broke, Ashutosh. Can you repeat?
I was saying that the liner plant will come up by March and April this year. So maximum, any incremental volume we should assume only in FY24.
Exactly. We should get some volume out of that new plant. We are already doing mill linings from our existing plant, which will move to the new plant, get it up and about. Hopefully, we are able to take some volume. The mill lining conversation is linked to travel. And if people are able to travel, I think the sea freight is not as much a deterrent in the mill lining bit. But, it's a question of selling the solution. Now that the plant is up and about, I think we'll be kickstarting our efforts, hoping travel is a little more freer in next 2 months,
Okay, thanks a lot.
Okay, thanks, Ashutosh.
Thank you. The next question is from the line of Senthil Kamraj from iThought. Please go ahead.
Hi, thanks for taking my question. First is on the medium term time period, like 3 to 5 years. What kind of volume growth that the company is saying? Like you have said, like FY24 will be adding. So if you can take a 3-5 years and you can give a growth aspiration that the company is targeting.
I think if you talk of a 3 to 5 year horizon, I think volumes should be comfortably at least double than what we are currently having.
Great, sir. And any particular mineral you want to targeting?
This is the vision, and this is the efforts with which directionally people are working, and that is the opportunity, and that is the confidence. So these are all the factors to be taken in a broader sense.
Okay, thanks. And second question is on the capital allocation side. So as you mentioned, we have a net cash close to around 2,000 crores. So going forward, on the dividend payout side, can we see a much higher payout ratio going forward, or is the company going to focus much on the growth side?
So currently the focus continues to be on the growth, dividend payout, or returning surplus cash in one or the other way has always been a question that we have faced. I think internally we have taken a call, the management has taken a call that till we reach 350,000 tons volumes and a little bit of more consistent growth visibility, we should have a little more comfort in keeping or carrying higher amounts of cash, either for, in case if we come across any opportunity, or in case if we have to do some aggressive capex, or suddenly there is a little more demanding working capital. So all these three factors, I think at least for another 1 year, say till 23-24, a more aggressive payout is not something which is on cards, to be very honest with you. At least 22-23 end. So we will take a call after 6 to 12 months, and then we will become aggressive if required. There's not a problem.
Okay, sir. That was helpful. Thanks.
Current payout is 20%. We maintain that.
Okay, sir. Yeah. Thanks for the clarification.
Thank you. The next question is from the line of Sandeep from JM Financial. Please go ahead.
Yeah, good evening, sir.
Good evening.
So my first question is pertaining to this 36% increase in realizations, gone from 105 rupees to 143. If we were to break the same, say into price pass-through as well as mix change, because you said you're doing more castings or volumes in some of the countries which had lower realizations, the sales have gone off.
Right.
How much would be?
Sandeep, majority is a raw material price pass-through. What Sanjay was trying to answer was with a context that don't look at it sequentially quarter to quarter. So even for 9 months the realization is 129, right? So it's moved from 105 to 129. Is more reflective of the raw material increase than just looking at one quarter. That's all he was clarifying.
Okay.
Material portion of this increase is raw material.
Okay.
And freight, raw material.
38 rupees increase, majority would be price pass-through that we have taken, right?
Yeah.
RM and freight.
Raw material and freight.
And freight. Got it. Second question was on freight cost. You highlighted there's a 20 crore increase on a sequential basis. And last quarter you had guided it was somewhere about between 90 to 95 crores. So is it such a big jump that about 110 crores in this quarter is the freight cost? Because then that's is that number correct?
Correct. 110 crores?
No, 1 sec.
Sorry.
Sandeep, 1 sec. You wanted only the...
97 to 114. For the quarter, no? Quarter. 110 is correct. So you're right. Thereabouts.
Got it. Okay. And third question was on this Canada and South Africa volumes. So you had earlier guided us that last year we did combined volumes of about 24,000 tons in these two geographies. We did some small volumes in this year also because cement volumes are still on. So if you can guide what will be the like-to-like number we can do from these two geographies in this year, And given now you would have had some conversations, because Brazil also, what we saw initially, there was a dip and then some volumes started coming up from that geography. What is your sense where this number can stabilize, say, over FY23-24 on an annual basis?
FY23, I don't think we'll see, maybe because it's linked to sea freight as well, right? Canada has in addition to duty, there's a sea freight that's just large, for the volume that we are looking to sell in that market. I think FY23 may not be much. FY24, at least, we'll attempt to get back 30% of the volume, That will be our attempt towards the later part of second half of FY23 and FY24.
Got it. Also, another question is on, you made a comment during the opening remarks that the customer conversion cost has gone up to some extent when you are giving demonstration. So,
customer conversion cost? I didn't understand.
When you're trying to pitch a new product to a customer, you said
because of the freight cost. No, the delta is higher, because of the freight cost. The cost is 100. Okay, forget raw material, right? On 100, my normalized rate was 10. If it's become 30 or 40, it's become a material part of my cost now, right? And something that looks to be transient. The world has not seen sustained sea freight levels at current pricing, for a long time. So it is not a supply demand issue. It is a supply chain issue. And the interruption that we are having in supply chain, and we are hoping that should correct. I mean, we are nevertheless working so that because we believe our value addition is actually more than the incremental cost of freight. But when you are having a conversation, it's just an irritant, right? That now the incumbent is that much less cheaper. If not just the price between chrome and iron, but also the differential of the sea freight that we'll have to pay now, in the current price regime.
Okay. Understood. And last question is on the growth. Of course, we lost volumes in these two geographies, but we are still flat on a YOY basis. So which are the major countries where you are seeing higher growth, which have compensated for the volume loss in these two regions?
So Americas has done well. Somebody asked us about Chile. We've started doing volume in Chile. This whole year we should do reasonable volume, for copper mines over there. We're doing
Australia.
Yeah, we're doing Australia, South Africa. Africa as a continent is interesting for us. So all of it, a little bit of cement, uptick that was there. Last year was a little bit of a dip, so a combination actually. There's no one country or ore type that's led to the increase.
Right. And lastly, just one bookkeeping on the tax rate. That seems to have come off significantly. So what should be the assumption that we should go by?
Tax will be about 22% to profit before tax.
Got it. Okay. Thank you so much, sir.
Thank you, Sandeep.
Thank you. The next question is from the line of Priyankar Biswas from Nomura. Please go ahead.
Good afternoon, Sanjay Bhai and Kunal. My first question is regarding to the mill liners. So can you just tell me, the first part is like of the 250 crores that was budgeted for the mill liner expansion, so how much would we have already spent in this?
So we've spent already about 150 crores, about 140 to 150 crores. I don't have the figure on the top of my head. We still have 50 crores to go from here on, till we commission the plant.
Okay, so it's almost like done.
We may commission.
Yes, please.
To get installed, right? So the heart of the plant where we can start trials, will happen in April, but the spend may continue beyond that,
So here, related question, like it seems one of your Indian peers in the mill lining segment, so they have kind of highlighted that composite mill liners are gaining a lot of traction and market share versus metal mill liners due to some technological developments. So what is our value proposition here that from let's say FY23 or even onwards, so in next 3-4 years, that we should be able to sell our volumes and maybe reach a 60-70% capacity utilization?
No. So in 4 years, reaching 80-90% is a clear plan. There's no question of it. First point, right? I think we believe that the point is that we've been working on a metal, rubber, composite, polymer, composite for more than 5-7 years. Okay, so I mean there are places where that composite can work. I don't think it's a proprietary technology that's not unavailable. But the point is different, Priyanka. The point is, where does an improvement in the metal come? It can only help you with the wear rate, right? What does the composite do? It will help reduce the wear rate. We are not playing on that pitch at all, right? What we are saying is, if you move to our designed metal liner, will improve throughputs by 20%. If you are a plant producing 1 million tons, would you be interested in producing 0.2 million tons more, or reduce cost which is equal to 1/10 or 1/20th of that additional contribution you can make?
So our value proposition is mill optimization, right?
Exactly. We are doing a design intervention with the mill linings on the metal side, where we can improve throughput by 15-20%, we can save power by 15-20%, and to an extent improve recovery because of the grind size distribution and all that improves. But forget that, just the throughput improvement. Why is throughput improvement important on a tactical basis? Is because how else does a plant improve its throughput? If it wants to produce more, it has to set up a new line. With our mill linings, you can give them a 15%, 10%, 20% more throughput, which means mine more metal to that extent. There is no choice available to increase that today in the existing scheme of things at a mining company.
Okay.
Right. So one is to be able to produce more. Second is to be able to, add more contribution. Third is to reduce cost on account of power. The combination of all these three is 50 times more or 100 times more than a potential wear cost benefit that a metal to composite can bring. And metal to composite is an incidental thing. Like I said, we've been working, our proposal on a composite was made 7 years back to a client. So it's not a hot rage that everybody is talking about. If there is a niche area where there could be an opportunity for it, we'll see. I mean, that's incidental to our to where we are at, which is a design-led intervention.
And Kunal bhai, my second question, see, your production numbers are significantly higher than the sales. So like assuming some bit of normalization in, let's say, the freight situation that we have, so would it be like fairly reasonable to assume that in the last quarter we may do something north of 75 KT? I mean, is it possible?
That is so difficult. I mean, we are working with so many variables, Priyankar. What we'll do in April is unknown. I mean, there are plenty of things in front of us. I think we should do well, but what number it is, I think we would not want to hazard a guess on it. It does not matter 5,000. It's 65 or 75 does not change this whole commentary that we have about our business, right?
Yes, but if you do something like 75, you are actually growing. I mean, YOY, despite losing some volumes in Canada.
That is cosmetic, right? Growing 2% is not where we have invested all this effort on. We want to grow by 50,000 tons. Those are ton karke, we can claim we've grown, but that does not move the needle, no? So whatever it is in next quarter, I think directionally, sea freight, normalizes is a big inflection for us to start our growth journey. I think that's how we look at it. Next quarter at 70 or 65 or 75,000, notwithstanding,
Okay. So that's all from my side, Kunal.
Thank you.
Thank you. The next question is from the line of Aditya from Securities Investment Managers. Please go ahead.
Hi, sir. Thanks for the opportunity. I recently started tracking your company, so pardon me if my questions are a little basic. I just wanted to understand if it is possible for forge media grinding players to enter high chrome market, or is there some technology that you have or the way you produce that only you and other players who are currently present? Is it possible for forge media players to enter?
No. So, okay. I mean, you have asked a very fundamental question. So, let me just clarify one thing. See, what we are doing today, essentially we are now directly focused on converting customers away from forged grinding media to our high chrome grinding media. That's the entire core of our focus. So it's very obvious that what we are doing, a forging player cannot do. One, what we are doing is technically we are manufacturing alloys, so which is a castings process. All we have is therefore a foundry technology, whereas a forging guy doesn't produce alloys, he uses 100% pure metal, and which is then very hard and made. Hello. Am I audible? Hello.
Yes, sir. Yes, sir. You're audible.
Yeah. There was some mix-up. So technically, whatever we are doing is completely different than what a forging guy is doing. We have not seen any other forging player even coming close to the solution that we are offering through a combination of either, as Kunal explained, the mill lining based approach, or another very important approach is the DP or the down process benefit that we believe that our high chrome media can offer through reduction in the cost of these very expensive reagents like cyanide, etc., and improving the recovery. Improvement of recovery, particularly in metals like gold and copper, plays a very significant role, and therefore we believe that eventually initial resistance is always there, but eventually the customers, they do see the significant benefit that we offer on the table, and they start converting. That process is absolutely on. 1 or 2 quarters here and there doesn't matter, because it's not directional. It's just a temporary blip. But we believe that there is a huge market, at least a 2.5 million ton opportunity, and between the two ores, that is copper and gold, and plus of course iron, it's a very, very significant opportunity, and we think that the customers have started seeing the great benefit due to the combination of all the factors, and conversion has already started to happen, and it will gain pace as we go forward.
So just to follow up to that, I understand there are benefits of converting from forged to high chrome. I just wanted to understand the production. Is there any difference in the production manufacturing of high chrome and forged media players? Just hypothetically.
Yeah, it's completely different. They just happen to be the similar spherical metal ball. At the end of the day, the production process is completely different. Not comparable. One is using impact to force it into a shape. The other is actually using scrap and liquid metal, and then getting into it's a cast product versus a forged product for the other incumbent.
Okay, so got it. So one more question. Can you just give me a ballpark figure of the percentage of sales from grinding media, mill internals and castings? Just a ballpark figure. And what's the trend been like over the last 4-5 years?
What is the percentage? I mean, we've not been sharing that, or disclosing that particular number. It's got other connotations with that. So you'll have to treat it as a mix right now. 187,000 tons that we've done on all are high chrome products for us. We just talked about grinding media and cast. Other than grinding media, to share that the realization could be different. That's all.
Just and a trend like, and what's been the trend? Can you just give me a trend like if there has been an increase in sales of mill internals?
They generally grow in tandem. You don't have a product. You may have sequential quarterly plus and minus, but over a few years, if you look at it, it's comparable. The mix is not changing drastically.
Okay, fine. And just one more question. In your annual report, there is consumption of stores and spares, which forms almost 8 to 10% of your cost. So what are these, and are they linked to your scrap steel and ferrochrome prices only?
No, stores and spares are all production consumables. When you make mold, for example, you have sand that gets used, right? So these are production consumables, and then there are these maintenance parts that get used. So a combination of two gets accounted under stores and spares.
Okay, so they're not related to scrap steel and
raw material is under raw material. No, stores and spares is not raw material. I think that's not more than 5%. I would not imagine it's 8 to 10%.
Okay, fine. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Ashna Manaktala from ICICI Securities. Please go ahead.
Yes. Hi, sir. Sir, my question is related to as you mentioned in the starting, that inventory buildup has been happening largely due to the supply chain challenges that you've been facing. So is this a trend that we should be looking at going forward?
Not really. So this is specific to this quarter. I mean, till now things looked okay, but with the Omicron, with the Chinese situation coming in, we saw some interruption where it's just taking longer. I don't think this can be generalized. We may not add much more stock now. I mean, this is already a stretched supply chain. We would be surprised if it goes beyond this. For now, you can consider current working capital levels.
Okay, sir. And sir, I also wanted to understand one thing, like in our other income for standalone, it has gone up significantly in this quarter. And such that the standalone PBT is higher than the Concall PBT. So would you be able to explain the reason for that?
This quarter includes dividend. See, standalone company, we have a step down wholly owned subsidiary outside of India called Vega Middle East, which distributes all our products outside of India. So that company passed on dividend to the parent company, which is AIA. So in a standalone AIA, that appears as a dividend income. That's why the other income looks disproportionately high. But that normalizes when you look at the consolidated number. That gets knocked off.
Okay, so that's entirely is the dividend.
Yeah.
And one more, in terms of the volume, especially the non-mining volume for this year, on a quarterly basis, it is trending slightly downward. So again, is that something we should be looking into as a trend?
Not really. It's just incidental to this quarter.
Okay, so you had guided around 80,000 metric ton for the entire year in the previous calls. So would you...
That should continue, yeah.
Okay. And, okay, fine. That's it from my side.
Thank you.
Thank you. The next question is from the line of Abhishek from Ambit Capital. Please go ahead.
Hi, thanks for taking my question. My first question would be on the volume growth that you have guided on 3 to 5 years, which are expected double. I wanted to know what steps the company is taking. I understand apart from the market forces and the copper to do well, but if you could just talk on what we as a company are taking steps there, that would be helpful.
Yeah, so I mean, to the extent of duplicating ourselves for the rest of the audience, the grinding media market is in excess of 2 million tons in the incumbent type, which is the forged grinding media, right? And we believe we have a superior product, which is the chrome product. It's akin to a normal rubber tire versus a radial tire, right? There's or a 4G versus a 3G. This is a better technology product, which has inherent benefits, along with that come along with it for a certain section of the application. If we are total chrome is under 450,000 tons, there's at least another 1.5 million, 2 million tons that's using chrome. We believe there's another at least 500,000 tons that can be converted to chrome. And, we believe we are in the right place in terms of available capacity, etc., to, take advantage of that opportunity. And where chrome brings all these benefits of being able to improve recovery of copper and gold, reduce toxic reagent consumption, and combine that with our mill lining solution, where we can offer a complete integrated, offering to the customer, where they are not just buying parts, they're buying a solution. What is the solution? Of being able to improve throughput, reduce power consumption, reduce wear cost of our parts, improve recovery of the ore, the metal from the ore. So that's step up from being a part supplier to a solution provider. That's where we are focused on, and we hope that at least another 500,000 tons should get migrated to chrome. That's the bet that we are making.
Right.
And at least half of that should come to us then.
Sure. No, Kunal bhai, I understand the opportunity is huge here.
So from an effort standpoint, so that's the opportunity. From an effort standpoint, we're making sure that we are talking to as many customers as we can, right? And we've discussed this before, that customers are conservative, they are not really keen to change status quo. So that's the whole journey where we're going to customers, explaining them about the solution, talking about work that we've done at other clients, right? All these benefits that have accrued to them. We do 265. Our competitor does at least another 300,000 tons in the chrome space. Chrome was not existing 30 years back or 25 years back, right? So all that we've done, all that AI has done over these many years has come on account of exactly what we are required to do going forward, which is approaching a customer, demonstrating a solution, doing trials, doing proof of concept, right? And ultimately getting into a commercial sale thereafter. So that same process continues. We're doing a lot of work in terms of developing the market in Australia, Africa, and America. That's where a large part of our market resides. And right from getting the right people on the ground, reaching out and creating relationships with customers, getting trial opportunities, and so on and so forth.
Sure. I get this. My second question was in link to this part where you said that we are trying to convert the clients. My question is, what is actually holding the customers back? I understand the initial upfront cost is high, but later on the efficiencies are high. But apart from the upfront cost, if you could mention what is the on-ground feedback, what's holding them back?
It's a very, very complex ecosystem mining runs, right? They're all in rural setup, they're away from city centers. They're used to a certain way of doing. They're just a very conservative bunch. They're used to a status quo, right? Mining is not a sunrise sector. A lot of work has been already done. So there is a lot of anxiety when a customer talks to us about really whether we'll develop all these efficiencies that we talk about. They're not used to a part supplier going and talking about a solution, right? It's like saying I'm a tire supplier. If you buy my tire, I'll optimize your engine, right? That's not generally expected. And that is where it starts from this general conservatism that whether all these benefits will accrue. What if I go and change something negative happens, right? We're talking about improving throughputs by 10%. What if it worsens by 5%? So at some point in time, it's that fear that of changing the status quo. And it's not a homogeneous customer. If I'm an Infosys, I'm selling Finacle to a US financial sector. It's a homogeneous crowd I'm selling to, right? I can optimize for that geography, for that culture, for that spoken instruction, etc. In our case, it's across the world and across ore types, right? So people are different, their expectations are different, But across the board, we run into a conservative mindset. And that works well for us, right? Because whatever we take, it's a sticky business. We've gone through every single imaginable tragedy in our business, and yet we've come through, right? All these price pass-throughs have come through, and the point is our business is sticky. So it takes time, but it's sticky after that. It's sticky because the same conservative nature helps us to keep that business thereafter.
Right. Sure. Got it. Thanks a lot, Kunal bhai, and all the best.
Thank you. Thanks. Hello?
Yeah, I'm done with my question. Thank you.
Thank you. The next question is from the line of Prateek Agarwal from ITI Mutual Fund. Please go ahead.
Hi, sir. I have just one question regarding your comment on doubling of the volumes, which you had just answered. But just to extend a little further on that, doubling is in 5 years is equivalent to kind of 15% CAGR growth. As I remember, 2-3 calls back, you had mentioned that on a regular basis, organically, 6-7% or 7-8% is the growth number, volume growth number that you can do very well easily. So just to reconcile these two pieces of information, that 7-8% growth versus 15% growth means 15% to double up, but earlier comment was 7-8%. So just asking you whether it includes something else which I am missing.
No. So first of all, Mr. Agrawal, I must clarify. I was very clear. Somebody asked me a question, where do you see after 5 years, where can you go? So just to give the idea that there is indeed an opportunity on which the company is working very hard, we said, if it's a vision statement, then in 5 years I should double. Now that does not mean that there will be a CAGR which you will calculate, and so I made it clear that it is not a guidance, but look at it from a broader perspective, that if I am saying that the market is about 2 to 2.5 million tons and mining is growing and our entire focus is on these 3 or 4 ores, more particularly the 3 ores where the opportunity itself between the 3 is more than 1.5 or 2 million tons, where the level of penetration is hardly 10, 15, 20% today. And we believe that the solutions that we have they have extraordinary capability of conversion. That was a directional statement I made to ensure that people continue to get the same sense with which company remains excited and we are working hard. So again, I repeat, there is no such guidance that I want to give. I am saying that is the opportunity. I am saying that's a vision, and therefore there is no question of reconciliation. The figure of 25, 30, 40,000 tons annual normalized incremental volume is the minimum volume growth which we believe we should achieve once the macroeconomic and the supply chain system becomes a little more predictable and a little more normal. And that is why we said that for next year we don't want to give any guidance, but we will wait and watch, and as supposing after this year or maybe in the first quarter situation looks better and the way we want the things to start moving, we can give a specific guidance. So there is, please sir, don't try to reconcile. That's our humble request.
Sure, sir. No, understood, sir. No, that was helpful. Thank you, sir. Thanks a lot.
Thanks.
Thank you. As there are no more questions, I would now like to hand over the conference to AIA Engineering management team for closing comments.
Thank you, everyone. I hope you all are safe. And as usual, Sanjay and I are available for any offline calls. Thank you. Have a great evening.